Is about the RBI. The banking regulator, the RBI, is introducing draft norms for the acquisition financing by banks. And these draft norms are proposing this, that acquisition finance can only be provided to a listed company which is profit-making for at least 3 years. Also, a bank's exposure towards acquisition finance does not exceed 10% of its Tier 1 equity. And what we're picking up is that acquisition financing can only be provided to the acquiring company or its special purpose vehicle, its SPV. And intermediaries like NBFCs and AIFs, they are not eligible to receive acquisition finance. Let's find out more from my colleague Vishy. He's joining us with this piece of news. Vishy, now the RBI is coming out with this entire draft norms, which is proposing all these elements within the acquisition financing by banks. Detail for us what exactly they are proposing here.
Vikram, so this conversation started in early October when the RBI governor first introduced the concept of acquisition financing by banks during the monetary policy speech that happened. At that point in time, of course, we knew that banks would be allowed to enter acquisition financing. However, the rules and the guardrails that will be put in place to protect the system from any kind of risky behavior, those were not clear. So that seems to be clearing now with these draft set of guidelines. Again, I want to clarify that these are draft guidelines. These are not final norms. Depending on public commentary received, the RBI will tinker with these norms, and then the final norms will be the ones that will be actually applicable. So let's look at where the draft regulations are coming from. They are obviously trying to limit bank exposure to acquisition financing towards companies which at least have 3 years of profitability and have a satisfactory net worth. This is something that the RBI's draft regulations clarify. The 10% limit of Tier 1 capital is also an important number, because obviously that will ensure that excessive lending towards these companies does not happen. The other guideline which will act as a guardrail is that a bank can only finance up to 70% of the acquisition value in any of these acquisition financing cases. The remaining 30% has to come from the acquiring company's equity flows. So that means that the acquiring company will have skin in the game, so that it will ensure that the banks are not the only ones taking the entire hit in case an acquisition fails. The reason they've kept intermediaries like NBFCs and AIS out of this is because they are not the ones directly funding any acquisition of their own. Financial sector acquisitions have been barred. So even if an NBFC wants to go out and acquire another NBFC, they can't dip into the bank account to get that. Another important guardrail is that the acquiring company and the target company, they cannot be related parties. This is to avoid any kind of systemic risk that may come up because of these rules. So these are some of the important features as part of these draft guidelines. Of course, depending on public commentary, as I said, the final guidelines will come into force at some point in time in the future. If November 21st is the last day to submit public commentary, so typically the RBI takes about 6 months before the final guidelines come out. So at some point in time next year, we will see what shape this entire thing takes. Last thing I want to point out is the fact that acquisition financing for banks is a completely new set of business, specifically for the domestic business, because earlier banks were allowed to finance acquisitions abroad. So an Indian company that is working abroad can take that money from the foreign branch of an Indian bank and finance that acquisition. But Indian companies, acquiring companies in India, borrowing from an Indian bank, that is something new that is coming through with these guidelines, Vikram.
Vishwanath Nair reporting on the RBI now introducing these draft norms. Like he's pointing out, this is an entirely new territory by way of acquisition financing by banks. Now there are draft norms that have been put out. Of course, it will be some time. This is for deliberation, for public deliberation, and eventually we are likely to see perhaps early next year when we see the exact shape that these norms take. But Vishwanath Nair, thank you very much for joining us. We take a small breather. On the other side, of course,